Good morning, I'm John Ellsworth, founder of Success Strategies Incorporated and the creator of the Success Strategies Advantage, and I want to welcome you to today's presentation, which I have entitled, Who Benefits from Delays? I've had some interesting experiences recently with clients and the loan approval delays that they've been through for, I would suggest, no good reason, because I have to ask you a question. If all the information is in that's been requested, and it's all good information, it's all solid information, why does it take 3 to 4 weeks beyond that point to analyze it? I could think you could analyze the whole federal deficit out of existence in 3 to 4 weeks, but that's just my personal opinion. I don't understand these recent delays, but I want to talk about who benefits from the delays. Number one, does the borrower benefit at all? Well, first of all, I would say an absolutely no, because what happens is typically there's some vendor uncertainties. Their vendors start thinking, gee, I don't know if they're going to be around. Should I raise prices? Should I collect now? Should I get additional money from them while I can? It starts to just frankly generate a lot of doubt about a producer's operations. Number two, what happens? Does the borrower benefit if interest rates increase? As in case you haven't noticed, it's been the last 18 months, 18 to 24 months, we have been on an upward trajectory on interest rates. And guess what? That costs producers more. So delaying this process, not being able to fix rates, things like that, can be a real financial setback for operators. On the flip side, does the bank win? I know sometimes people go, oh, the bank's just doing this intentionally. I'm not suggesting that because I don't think that's necessarily the case. But does the bank win? Like, are their margins going to go up if they wait for the rates to increase? I don't think so, because if I understand how their cost of funds work, their cost of funds or cost of money that they're borrowing from various sources, whether it's savers or the Fed, those rates are going up too. So at best, they probably will end up with about the same net margin compared to their cost versus what they're charging a higher rate to borrowers. And worse yet, I think the bigger concern from the bank's perspective is if the borrower's operation is on a downward trajectory. In other words, if their performance is being impaired in any way, shape, or form by this delay, and oftentimes it can be, I think that increases the amount of risk assumed by the bank. And that is not good news. Besides, if vendors increase their prices, and can you say inflation the last 2 years? If they increase their prices, there's absolutely no doubt that the producer's profit margins are going to get squeezed, as we've seen particularly over the last 2 years. And all I can say to that is, ouch, that hurts from an operator standpoint. Winston Churchill said, and I quote, "The ultimate sum of the maybes is always no," end of quote. And so it's never positive news. So my suggestion, particularly to the lenders out there that are listening to this, let's make a yes or no decision and move on. If the answer is no, it's not the end of the world. At least it gives the borrower the opportunity and the reason to move forward with a different lender or a different source of funds. Maybe it's a lease instead of a loan type of thing. Because I think importantly, what we need to remember is loan decisions are not like fine wines. They do not get better with age. So let's move forward, stay on track, because Churchill also said, and again I quote, "Let our advanced worrying become advanced thinking and planning," end of quote. I think that's good advice for all of us today, whether you're the borrower or the lender. It's good advice. Let's just move forward, stay on track, and make the best decisions, the most informed decisions that we possibly can. One last item I want to toss out to you. This has already been released. You can find it on our website, which is right above my head here, successstrategies.com, with a dash in the middle of it. But we have recently introduced a product called the Success Strategies Advantage software. We've worked on this for several years. And essentially, this is a tool that you can use as a dairy producer to get a year-to-date cash flow comparison of your actual results versus budget. And the budget, of course, would be based on regional averages, just to give you an idea how you're doing compared to others in your region. It'll help you determine the break-even levels, which can be very helpful, very useful when you're doing Dairy Revenue Protection or the Dairy Margin Coverage Program helps you to know what your break-even levels are, where you've got to be on milk price, production level, things like that, feed cost. And it also provides what I would consider very positive information for you to sit down with your team, which could be your veterinarian, nutritionist, herd manager, maybe your banker, other financial advisors, and talk about what we're seeing in your operation from a cash flow perspective, and what you think we need to do to get us going on an upward, on a rising trend line. So, and ultimately, I think we were talking about loan decisions earlier. I think ultimately it is information that will be very beneficial to your banker. It is not a CPA prepared financial statement, but it'll clearly illustrate that you know what's going on in your operation from a cash flow perspective. And this, combined with the other CPA prepared financial statements, can be very beneficial to you in your loan process, your loan approval process, if you will. Again, I'm John Ellsworth, founder of Success Strategies Incorporated and the creator of the Success Strategies Advantage. And if you go to our homepage, down toward about 2/3 of the way down, you will see the Success Strategies Advantage. There's a video there, there's some introductory information there, and I would encourage you to visit it. Thank you for listening today.